For many investors tuning into CNBC, Fox News, or Bloomberg all too often, the idea that stocks in the S&P 500 could be nearing all-time highs again is inconceivable. Wasn't there near unanimous agreement in the third quarter of 2023 that we were heading for a recession in the first half of 2024? Alas, we didn't, and stocks are much higher, almost exactly 1,100 S&P points higher from the late October bottom. But even after such a run, many of those same personalities who got it wrong for their followers for the better part of 2 years are still on TV, preaching doom and downside. While their theories may one day be proven correct, exactly how many months, quarters, years, or even decades in the case of Jeremy Grantham do they get for being early? Investors, being early is a polite way of trying to disguise being wrong, but not admitting it. Even the greatest investors, like Jim Simmons of Renaissance Technologies, who just passed away last week, are far from perfect in this business. But at some point, even the greatest investors have to admit they're wrong, not just early. Investors, so far, the old normal has played out for 2023 and year-to-date 2024. What would more of the old normal look like the next few months? Well, historically, the last couple of weeks aren't the best for stocks. So, with the stock markets near all-time highs and volatility now back down around historically low bound for over 3 decades of around 12.5 spot VIX index, X that 2017 Goldilocks year, I would expect some sloppy stock behavior in the coming weeks. It's quite rare for stocks to break out meaningful new all-time highs on the first attempt, as many traders who bought late in the move are happy to be back to break even, and sellers tend to pick up their pace. Take a look at the daily chart of the S&P 500. One can see the market lows in October of 2022, March of 2023, late October of 2023 as well, and most recently, mid-April option expiration Friday, the 19th of April. Looking back, an investor can also see prior times in the last 2 years when the market stalled for 2 to 4 weeks before breaking out to new all-time highs. Take a look at the same S&P chart for the second quarter of 2023 and mid-fourth quarter of 2023 highlighted in gray. These are the times of prior stalls we made right before breaking out to new highs. This timing for a stall would also coincide with the work of Larry Williams. Here's the Larry's best fit pattern for 2024 into 2025. Remember, investors, Larry's work was published in early January of this year. So far, Larry's work has been spot on since the COVID lows of 2020, and it's been a good divining the future path of overall markets, including twists and turns along the way. The models our investment team has been following for quite some time have 2 very different outcomes for late 2024 and early 2025, but they both agree with Larry's work currently. Yes, believe it or not, the Goldilocks soft landing, Greenspan-induced cycle of 1995, as well as the bursting of the dot-com bubble in 2000, both played out in similar manners in mid-year with a very normal summer rally. Take a look at the chart of the S&P 500 in 1995 when Alan Greenspan orchestrated one of the only extended soft landings in our country's history. That year, the S&P 500 was up a little over 15% year-to-date, near in a straight line into May. It paused for the month of May and bottomed close to the lows the last Friday in May, May 26th to be exact that year. The overall stock markets then went on a significant summer rally of almost 7.5% from there into the end of the July, call it the beginning of August peak. What asset class outperformed the S&P 500 back then by a wide margin? The Russell 2000 gained almost 11% over that 2-month period, besting the S&P 500 by almost 50%. Take a look at the chart of the Russell 2000 back then. The really impressive part of this chart is the blue line in the background. That's the relative performance of the Russell to the S&P 500. While the Russell had been going up all of 1995 and making investors money, it was dramatically underperforming the S&P 500 until, yep, you guessed it, the last day in May. I bet you're asking yourself, why would Chris discuss the Russell 2000 in years 1995 and 2000 in the same video? Goldilocks 1 year, 1995, and the dot-com bubble bursting in 2000? In that order? Well, because believe it or not, the Russell 2000 did near the exact same thing in late May 2000. What's that? It troughed the last Friday in May, market on close, and promptly rallied 13% into late July, besting the S&P 500 during a summer rally few investors recall because most were licking their wounds from the initial wave down in March and April of 2000. Which brings me to this week's lesson and the main point of this video. Investors, historically stocks rally in the summer. Why? I don't know. But if you're interested in looking for a summer rally, keep an eye on the Russell 2000 into late May. For investors or retirees uncomfortable with a wider range of possible equity outcomes, the Oak Harvest investment team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges and shock absorbers for stock portfolio. The information on this exciting new strategy can be found on our oakharvestfunds.com website. And the whole team here, I hope you had a great Mother's Day. Thank you and have a great weekend.